The principles of successful trading can be expressed in just 4 words: cut losses, run profits. Maximising profits while limiting risks is one of the keys to making money as a trader. Today we'll be looking at stop loss strategies. We'll look at the types of stop loss orders that are available to traders on the CMC platform. We'll look at some of the methods that traders use to set the level of those stop loss orders. And we'll finish by looking at some of the aspects of deciding how much capital to put at risk on any given trade. Looking at this order ticket on the CMC platform, we can see there are 2 types of stop loss orders: regular stop loss orders and trailing stop loss orders. A regular or fixed price stop loss is just that. The trader determines the level at which they would like to stop out of a trade that's going against them. A trailing order does exactly that. It follows the market as it moves in the trader's favour, locking in profits. If the market reverses, the trailing stop loss order doesn't move, and it's triggered at the lowest or highest level at which it had reached before that move. So experienced traders who understand the benefits of using stop loss strategies face a common problem. That is, placing an order with an attached stop loss order, watching the market go against the order just far enough to trigger the stop loss order, and then reversing and going in the direction of the original trade. Now, this is a source of frustration for every trader, and no matter how careful a trader is in setting their stop loss levels, inevitably it will happen at times. But of course, it's important to minimise our stop loss triggers, to set our stop losses at levels which give us room for our trade to go in our favour. So how do experienced traders set stop loss levels? Well, many of them use chart-based methods. And turning to the chart in front of us, I'm looking at the euro against the US dollar. And one of the most commonly used methods to set stop loss levels is to use support and resistance. Now, I've drawn on both a support and resistance line. I do understand that there'll be some argument about whether they're at the correct levels. Where you put support and resistance lines is entirely up to you. But leaving aside that argument for the point of illustrating as an example, let's say a trader wanted to go short euro US dollar at current levels, that is around 125.90. They could sell at current market and place a stop loss order just above the resistance level there at 127.13. Now, I say just above because one of the commonly occurring factors in markets is that we see a spike through a resistance or a support level before a reverse back into the original zone, and that's what could happen here. So if I was looking at doing this trade, I'd be setting my stop loss somewhere around the 127.20 or 25 level, just to allow for those small push throughs the resistance level. Similarly, if I was looking at buying euro US in the current market, I'd look at setting my stop loss below this support level at 123.55. But of course, that brings us to one of the problems with using support and resistance levels in setting stop loss levels, and that is they can often be too far away from current market to give a good risk to reward setup for the trade. So some traders move on to other methods of selecting good levels. Now, one of them is using the volatility that's against every instrument you'll see on the CMC Tracker platform, and in this case the volatility refers to the time frame of the chart, as it always does. So in this case, we're looking at the volatility over the last 9 months on a daily basis. And you can see that that's just under 12%. Now, to convert that to an expected average daily trading range, we simply divide that number by 16. And that's true because at all times, because the volatility expressed on a per annum basis, dividing by 16 gives us the average daily range. So in this case, we're looking at just under 12%. Dividing by 16 is going to give us a reading around 0.75%. And we then use that information to set the stop loss level. At current levels, 1.27 times 0.75% will give us a reading of around 95 points. Now, you can do that more accurately with a calculator, but for the point of the example, let's assume that that number is 95 points. Remembering how we got it, we took the annualized volatility we divided it by 16 to get a percentage, in this case 0.75%. We then took 0.75% of the current market price to give us around 95 pips. So once again, if I was looking at putting on a buy trade at current market, I could enter it here and place my stop loss 96 pips below the current market. That is 1 point outside what I expect the average range to be based on the volatility. Similarly, if I was selling, I'd place the sell order with a stop loss 95 points above the current market level. And in both cases, you'll see that that gives us a stop loss point that's inside those support and resistance levels, lowering the risk or the amount at risk on each trade. But once again, particularly for those using tighter time frames, the expected average daily range might not be useful. And there's another tool, particularly for intraday traders, that's very useful in helping to set stop loss levels. Now this is the average true range. And the average true range is a way of calculating volatility, but it also takes into account the trading range on any given day. The classic historical volatility we were looking at before, that purple number next to every instrument, is calculated from the close to the close. Whereas the average true range takes into account what happens between the closes as well as those changes in closing price. So it'll usually give us a reading above the classic historical volatility. And we pull it up by hitting the ATR button at the bottom of the screen here. This is in the technical studies area. We can then select the period of the average true range, but we're going to go with the current setting of 14 days in this case, and we simply confirm that, and it draws the average true range for us at the bottom of the chart. Now, one of the advantages of the ATR is that it's expressed in points, or whatever the currency or denomination of the instrument you're trading is. So in this case, the average true range for 1 day, remembering this is a daily chart, is around 120 points. And as we said, that's higher than the classic historical volatility. So once again, setting a buy order, we place a stop loss sell below the market, 120 points in this case, or 120 above if we're selling. Now some traders with a longer time frame will use a multiple of the ATR, 1.5 times the ATR or 2 times the ATR in setting the range. But for traders who've got a shorter time frame, and particularly those doing intraday trading, they often express the ATR in that time frame. So let's change now the time frame here to a 4-hour chart. And what we're looking at now when we look at the ATR is the 14 period average of 4 hourly bars. So for the last 14 bars here, we're calculating the average true range. And as you can see, and as you would expect given the tighter time frame, it's a lower level. In this case, around 42 points. Now we're starting to get to interesting stop loss levels to protect our capital. Because in putting only 42 points at risk, we don't need as big a move to give us a good risk to reward ratio on the trade. Similarly, if I was buying Euro US here, I'd be setting my stop loss 43 points below the current market. If I was selling, I'd be setting the stop loss level 43 points above. And if I was trading an even tighter time frame, I could reflect that on the chart as well by going into a 30-minute chart. And you'll see that the ATR drops again. Now we're getting an average true range on the 30-minute bars, the last 14 of them, of around 12 points. So if we had a tight time frame, we could look at reducing the stop loss gap even further using a tighter time frame on the chart. 3 very important chart-based methods of setting stop loss levels: using support and resistance, using volatility, and using the average true range. Managing the amount of capital put at risk on any given trade is important for every trader because it helps obey the #1 rule, and that is to stay in the game. When you enter an order on the CMC Tracker platform and enter a stop loss level, it will automatically calculate for you the amount that is at risk on that trade if that stop loss were to be triggered. One straightforward way to manage the value at risk on any trade is to look at it as a percentage of the trading capital you have available. By using a percentage, As you're successful and add to your capital, your trading grows larger. If you have a series of losses and your capital is depleted, your trades will get smaller. As a very rough rule of thumb, traders generally put at risk between 1% and 10% of their capital. Now, putting 10% of your capital at risk is a very aggressive trading strategy, and it's generally used by traders who take high probability, low frequency trading strategies. Those who trade very frequently, and particularly intraday traders, would look more at the 1% level as an appropriate level. On average, traders put between 2 and 4% of their capital at risk on most trades. Whatever method you use to calculate your value at risk and whatever value you put in will depend on your risk appetite, your trading method, and your decisions about what your goals are as a trader. But whatever method you choose, take a tip from top traders and attach a stop loss order to every order you place.